Hey everyone, so this exercise that we're going to work on today, this is chapter 5, exercise 1 that I'll be showing you guys here. So right here this question states, to prepare a journal entry to record the transactions listed above for Crane Co.'s books, and Crane Co. uses a perpetual inventory system. So the first transaction that we need to record here is on April 5th. It says that Crane Co. they purchased merchandise from Sheridan Company for $28,000, terms 410 and 30. So we'll talk in just a minute about what this here means. But for now, we'll just record the first part of the entry here. So go ahead and select the date of April 5th. And it says that the merchandise was worth $28,000. So essentially what's happening here is they are increasing inventory, so there's an increase in assets. So to show that, we're going to go ahead and debit inventory for 28,000. And then we're also going to put on account payable. We're going to credit that for 28,000 as well. So there we go for the first one. Okay. And then on the second one here, it says on April 6th, paid freight costs of $600 on merchandise purchased from Sheridan Company. So go ahead, April 6th. And then on this one as well, we are going to debit inventory. So let me type that in here, inventory. And it says it was $600. So we're going to debit inventory for $600. And then we'll credit, this time cash, also for $600. Okay, perfect. And then on April 7th, they purchased equipment on account for $31,700. So same thing with inventory, because the equipment is increasing, so there's an increase in assets. We're going to debit equipment. So let's first select the date of, let's see, that was April 7th. And then we're going to debit equipment here to show that there was an increase. Okay, and that was worth $31,700. And then that was said that was purchased on account. So we're going to go ahead and put that on accounts payable for $31,700. Okay, and then the fourth item here, on April 8th, they returned $5,100 worth, or excuse me, 500,000, 100,000, excuse me, let me just start over here. On April 8th, returned $5,100 of April 5th merchandise to Sheridan Company. So if we can see up here, on April 5th, they initially purchased $28,000 worth of inventory on account. But in this case here, on April 8th, they're returning $5,100 of that 28,000. So in this first item here, we did a debit to inventory and then a credit to accounts payable. So in order to show that that 5,100 was returned, we're essentially going to do the opposite here. So first we'll go ahead and select the date, April 8th. So to do the opposite, we're going to debit accounts payable this time. Accounts payable. And that amount was 5,100. And then we'll credit inventory also for 5,100. Okay. And then the fifth item here says on April 15th, they pay the amount due to Sheridan Company in full. So April 15th. So first here we have to determine what the amount is that they still owe Sheridan Company on April 15th. So if we go back to where we started, they initially owed them $28,000. And then on April 8th, that we just did here, they returned $5,100 worth of inventory. So that reduced that account payable. So here for April 15th, we're going to do a debit to accounts payable to show that they reduced that remaining balance and they ended up paying them in full of what was left over, which if we take 28,000 and we minus 5,100, that leaves us with $22,900 that they still owed Sheridan Company. So we're going to go ahead and do a debit to accounts payable for $22,900. And then for cash, this is where it gets a little bit tricky. So if we go back to the first item, it said that they purchased the merchandise and the terms were 4, 10, and 30. What that means is that if they end up paying Sheridan Company within the 10 days, then they're going to get a 4% price reduction. Otherwise, they'll have to pay the full price. So, and that was on April 5th. And right here on April 15th, they're paying them in full. So because that's within 10 days, they're going to get that 4% price reduction. So what's going to happen here is we're going to take $22,900 and times it by 96% to show that they're getting that 4% price reduction. And when we do that, when that calculation comes out, it's going to be $21,984. So essentially what's happening is they're getting a price discount. So instead of having to pay the full price here, because they paid within the 10 days, they're getting a price discount, and they only have to pay $21,984 instead of this amount here. So here on this last item, we have to show the difference of those two there. So because the amount that they paid for the inventory was reduced, there's also going to be a reduction to the inventory account, which will be a credit showing that that was reduced. So if we minus 22,900 minus the 21,984, that's going to show us what the difference was between those two, which ends up coming to $916. And again, we'll credit that to show that there was a reduction in the inventory. And then the last thing here to finish, it says here on Part B, assume that Crane Co. paid the balance due to Sheridan Company on May 4th instead of April 15th. Prepare the journal entry to record this payment. So the date for that was May 4th. And then it says here that we're going to assume that they're going to be paying the remaining balance due to Sheridan Company on this date instead of April 15th. So if we go back to April 15th, the amount that was owed was $22,900. So we're going to do that, keep that the same on this date here on May 4th. So accounts payable, we're going to credit that for $22,900. And then unlike April 15th, where they got that price reduction due to them paying within a 10-day window, since May 4th is outside of that 10-day window, they no longer get that price discount. So they're going to have to pay the full price. So what we'll do here is we'll do a credit to cash. And that will be for the same amount right here, so $22,900. And that completes our problem. So thank you guys for watching.